All right, so welcome to accounting. So let's go ahead and dive right into the introduction to what accounting is and how we know what accounting does. Okay, so in this case, this is the intro to accounting. This is the topics that we will be covering throughout these 15 weeks of this class. Okay, we will be looking at the basic principles of accounting. Okay, looking at how to collect, how to record, how to journalize, post the transactions, balancing the transactions. Okay, we're also going to be looking at the accounting equation, excuse me, and then we're also going to be looking at the generally accepted accounting principles, which govern everything that you do for accounting. Okay. We're also going to be looking at a merchandising type of operations where we're going to be looking at selling a product, right? But also, we're also going to be looking at how we purchase those products, right? Because we're going to be looking at being a merchandiser or a reseller, right? Where we're purchasing products that's already been made, right? We don't produce the products itself, and we are going to resell it to the public. Okay, and we're also going to look at how we collect those sales and everything that comes with the sales. We're also going to be looking at how to create financial statements too, which is very, very, very important because it is the basic fundamentals of knowing where your business is at when you create financial statements. And last but not least, we're going to cover payroll. Okay, right? Very basic operations of a business, right? I want to set up my business. I plan to sell a product. I need to first find a vendor or a supplier who will supply me the product. I have to sell my product and I need to collect the money from the product and I need to pay the people that work for my company. All right. So again, a lot of these things are basic business structures. Okay. So let's take a look at the different organizations, right? First, we have to talk about what the nature of a business does, okay? The nature of the business means when a business, okay, or an organization, okay, that has the basic resources and uses them such as materials, right? And what they do is they create a service or a product out of it, okay? And they provide these goods and services to the public, right? So again, the true main goal of most businesses is to make a profit. They want to make money, right? So in this case, they want to maximize profits, but also maximize savings, right? They don't want to spend too much money, but they want to maximize the amount of cash that they can receive from making a sale. Okay, so that is the nature of a business. Okay, main goal is to make money. And how do you make the money? Well, you cut costs and you maximize the profits. Okay. Now, again, this is the main thing that most businesses do, right? Because think of it as in general, right? Think in real life. Think of any kind of business that you see right now. They're all trying to make a profit because if they don't make a profit, they won't survive. Okay? So you have to really think about it that there are a lot of costs when it comes to starting a business, and you need to make sure that you generate enough money in order to operate the business. Okay. So again, there are 5 different types of business organizations. Okay. You got sole proprietor, partnership, corporation, LLCs or limited liability companies, and you have non-profit or non-for-profit, however you hear of them, organizations. Okay, so we're going to go ahead and break down each and every single one of these business organizations and see what their benefits are for starting the business. Okay, Sole proprietor, right? Sole meaning one person, okay? This person not only owns the business, but they are the business, okay? They are the ones who are going to be doing all the activities, all the they're going to be running the business as if this is theirs, right? Now again, this is because the key word here is sole, meaning there's only one person that owns the business. Okay? Now, if that means that person owns all the business, that means they own all the assets, all the liabilities, and the earnings. Pure 100% that the owner's money. So in this case, in the eyes of the IRS, the owner and the business is one. Okay? So again, here's a little fun fact, right? Because anybody can say, oh, I'm my own business. Oh, I am creating my own business. Well, here's a catch. The IRS will not allow you to continue being a business if you do not make if you do not make profits 3 years out of the 5 years that they give you the time frame to be a business. Why? Because that's the thing, because when you become a business, right, everybody knows that it is a huge tax deduction off of your own personal taxes. Okay? So here's a prevention for the IRS to prevent individuals who claim they are a business but really aren't doing business, right? Or aren't making a profit. So instead, if you cannot prove that you are making a profit 3 out of the 5 years you do business, you get considered a hobby. Okay? And a hobby gets taxed completely differently than a regular business. Okay? So they have set up a lot of rules and regulations to prevent anybody from creating a business so they can take it as a tax write-off. Okay? So fun fact there. All right? But let's go ahead and talk about the benefits and the disadvantages of developing a sole proprietor. Okay? Let's talk about the advantages first. Number 1 is it is the most easiest type of organization to establish. Okay? And it's the least expensive as well to start up. Okay? So what does that mean? Well, if you ever consider trying to build your own business, right? First things that you need to do is you need to go get a business license. So if you've ever visited the Nevada business website online to apply for a business license, it is fairly easy to do. It's a step-by-step walking process, right? You're going to sign up as a do business as, so DBA for short. And what happens is it's a very inexpensive cost. I believe you only pay about $100, and they have to, of course, run through your credit, right? Looking to see if you're able to handle opening up a business or not, and so on and so forth. So they're running your Social Security, they're running your credit score to see if you are able to open up a business and be able to have the ability to make the profits, right? But it's really, really easy. You just literally go online and pay $100, and if you get accepted, they will send you your business license right then and there. And this process literally only takes anywhere from 30 to 60 days. It's a very quick process because sole proprietors, that's the thing. Because anybody can establish a business, right? The only problem is that you have to have, of course, good credit, and of course, you have to also set up your collateral as well. So if you have enough collateral, okay, which we'll talk about what the collateral means. If you can prove that to the bank that you can have enough collateral that's worth enough to establish your business, then you're able to get your business license and they mail it to you within 30 to 60 days. So it's a very, very, very easy process. All you have to do is just make sure you have your business name, and if you That's the one thing too. You have to just have your business name. The business location can come afterwards. Okay. So then number 2, okay, owner has full control of making all the decisions to run the business. Yes. So again, oftentimes, a lot of individuals, they choose to run their own business because they do not want to do things a certain way, or they do not want to be told what to do, right? So they rather run their own business because then they get to make their executive decisions and they get to run the business how they want to. All right. So in this case, that's a huge advantage because, again, all those decisions that are being made, right, is purely up to the business owner itself, right? Number 3, okay, the owner can keep or reinvest all profits, earnings from the business. So meaning, so once the company starts earning money, right, the owner gets to take advantage and either, number 1, takes the profit, or they can reinvest the money into the company. Now, in this case, recommendation if you're starting out your business, rule of thumb, you shouldn't be taking the profits for yourself, just because, again, especially when you start your own business, you're going to be creating a lot of liabilities, right? You're going to be owing a lot of vendors because you need to set up your store, and it's not very easy to set up a store, right? You need to make sure you have furniture. You need to make sure that your store looks good. You need to refurnish some stuff. You might need certain things that are in your store that you are required to have in order to operate your business. There's a lot of cost and machinery that are going to be coming to create your business. So again, your best bet for the very beginning of its first year or so, or first couple months, you should reinvest that money back into your company. So then, 1, you get to build the value of your company, and then people would want to invest in you. Okay? And of course, the thing about this is that every dollar, every penny that is earned through the company is the owner's money. Okay? So, right? So that's a great advantage. Number 4, personal tax deduction. Okay, so again, I am not a tax accountant, so I am not in the profession of giving you professional taxation advice. So in this case, but it is one of those things that you need to know that as a individual who gets to file their taxes, if they can claim that they are their own business, it is a huge tax deduction, because what can you do? You get to write off a lot of your expenses, right? Because you could say, well, this expense was for my business. Because again, in the eyes of the IRS, you and the business are one. So in this case, right, on a personal tax level, right, you can write off yourself those business expenses, and so on and so forth, right? And it's a huge tax deduction, right? And of course, last but not least, it is also easy to dissolve. Meaning, if you want to abandon your business, all you have to do is just put your store up for sale, and close out your banking account, and report to the IRS that you're no longer doing business, and boom, that's easy. Done. Okay? Very, very, very easy. So then let's take a look at the disadvantages of having a sole proprietor. Well, first off, is that 100% responsible for paying any liabilities or debt. Meaning, anything that you owe. So we talked about collateral, right? Collateral is considered a personal asset because you can use anything, right? It could be your car, it could be your home. If you can't pay your liabilities off, those items that you use as collateral become the first thing that the bank repossess. Okay? Because if you cannot pay for $100,000 loan, they will come after your personal assets. So that's where number 2 comes into play, where it says all business and personal assets are at risk. So if you ever seen those movies where a businessman, like they come home and they realize that their home is being repossessed, their car is being repossessed, their paintings are being repossessed, that is an example of a businessman, a sole proprietor, putting up all of those items as collateral. So in case their business does fail, they take away everything that is business and personal. You lose your business, you lose your home. It's possible that you could lose your home, your car, your anything that you own that has some kind of value. Okay. And then number 3, right? Number 3 says limited to using personal savings and consumer loans. So again, in order for you to start a business, what do you need to have? You need to have money. Now, in this case, especially if you are going to be owning the business, you need to have your own stash of personal savings, or you can get a small business consumer loan. It's not that much. I know that it can start from anywhere from $10,000 up to maybe the most is $50,000, depending on your credit score. But you need to have your own set of money in order for you to start up your business. If you don't have your own money or don't get approved of a consumer loan, then that is a disadvantage, because you can't really start your business if you don't have some kind of investment, right? And you can't look for other people to invest in you, because then you're not becoming a sole proprietor. Okay? Everything is done through you. So if you get a loan, right, you are subject to have to pay that loan back, hence number 1. And if you don't, then number 2 will come into play, and anything that you use as collateral will be taken. So in this case, it is, again, a lot of stress when it comes to building your own business. And then number 4, does not attract high caliber employees. Why is this a disadvantage? Because think about it. We'll get into this section, but if you are starting up your business, right, especially a small business, and you don't really have that much money and you're not quite sure and you're starting up your business, the one thing that you'll notice is that you won't be able to afford any employee benefits. That's just because you're a small business, and again, the costs of doing everything else is too high, because you're going to be breaking your business into 3 categories, right? Your vendors, your customers, and your employees. So if an employee is about 1/3 of the cost of the business, think about it. That's a cost that is a little too much. So in this case, right, what are those costs entail? Those costs entails, are you going to provide benefits? Are you going to pay for insurance? Are you going to pay for dental, vision, and other insurance? Are you going to pay for life insurance? Are you going to pay for a retirement benefit plan? If you are going to be covering your employee that much, really think about how much cost it will have for having employees. And once that cost gets too high, then if you cut your cost and say, sorry, I no longer can provide a 401k, that's going to cause your employee to leave, because once again, if you can't protect your employee, what is the reason that they're going to stay to work? So most people, or most individuals, so most employees that are looking for those kind of smaller jobs, smaller gigs, right? Usually they are the people that plan to just use the company for one reason, and that is for just the experience, so they can move up either into the business, or they can leave the business and get an actual job that can protect the employee. Okay, so again, it doesn't attract high caliber working employees, right? And then last but not least, employee benefits are also possibly not deductible fully, okay, to the business. Okay, so once again, I am not a tax accountant, but in this case, There are certain benefits that cannot be deducted off of a business expense. So that is definitely not a good thing, because you want to, as a business, you want to deduct as many and save as much money from taxes, right? So in this case, that is not a good thing, right? Any questions so far about sole proprietors? Yes.
I have a question about employee benefits. What would sense would it make to have a benefit that's fully deductible from the business?
Again, I'm not a tax accountant. I wouldn't be able to give you professional advice about that. But in this case, if you are really truly interested, we do have a section for payroll. Again, if you remember the list that I showed you earlier, we won't visit payroll until chapter 12, which is about 10 weeks from now. So again, if that's something that you want to be very curious about, I do set up a link in there that allows you to go to the irs.gov, and it gives you everything, every detail about employees and how to tax them and so on and so forth. So you'd be able to learn a lot more information there. Yes.
But do you know why specifically for the sole proprietorship in this example the benefits are not fully deductible?
No, I do not know specifically why. Again, I'm not a tax accountant. I'm only the regular accountant. There, and we'll talk about the different types of accountants that you will see. So in this case, I'm not going to say yes and no for that question, because I cannot give you a confirmed answer without giving you whether it's correct or not, because I'm not a tax accountant. I cannot do that.
No problem.
Okay. All right. Any other questions in regards to sole proprietors? Okay. So let's talk about partnerships, okay? Partnerships literally can be two or more. So here's the key thing: it has to have two or more individuals that are involved into the company, right? And there are two different types of partners. You guys, you have general partners, and then you have limited liability partners, okay? So LLP. So again, that might be a familiar terminology, is an LLP. Now, in this case, right, a general partner, what is the difference between the two? So, in this case, a general partner, right, can have two or more individuals that are involved in the party, and each partner is going to have equal and, what is it, equal responsibility in regards to controlling and making decisions and things like that for the company. That means they are 100% involved in the company. Now, again, you're going to have to also think about how, if you're going to have three partners, right? What is going to be the percentage of the distribution between the work and the profits, right? You can always say someone can do 40, 40, 20. Some can do 30, 30, 40, right? If there's three people. So, again, that means you need to lay out all the responsibilities and how much of a profit each and every individual can get in each partner. Okay, so that is that's going to be the sole difference here, that every individual is going to be involved in the company. Now, for any reason, for a limited liability partnership, at least one of the partners is going to be the general partner. Okay? And that other partner is going to be considered a silent partner. So if you've ever heard of those partnerships that you hear about, that you have one person who's running the show and then the other person who acts as a silent partner, Their only mere job is to just be an investor. Yes. So yes, it's very possible with a limited liability partner is that you have a second partner or a third partner who's investing into the company, and they're only responsible for the investment that they put in there, and they're only trying to go there to make profit, right? And that is the limited liability partnership. Okay, so again, that's the huge difference between general and limited liability partner. Is general, all the partners are involved. Limited liability, at least one person is a general partner and the other partner acts as a silent partner. So let's talk about those advantages and disadvantages of partners. Okay, partnerships. Number one, it is also very, very easy to establish as well. But, however, the only thing is going to be setting up the agreement policy, right? Because again, you can't just say, "Hey, you and me, let's create a business," right? No, because there's a lot more things that are involved in setting up a partnership, right? Who's going to be doing what work? Who's going to be making the decisions? Who's going to be doing this task? What are the responsibilities of each partner? What is the profit distribution? Is it going to be 50-50 or is it going to be 80-70? I'm sorry. 80-20 or 30-70. Right? You have to come up with those responsibilities. And what happens when a partner leaves? What are you going to do there? So again, there's a lot of rules and a lot of regulations that you have to understand. That it does not mean that you can just go ahead and go into a partnership without making an actual contract with one another, right? So again, if you've ever seen those movies that they do verbal agreements. Yeah, verbal is not going to be there because, again, anybody can say that, oh, I'm supposed to get 40% of the profit. But no, there's no proof of where it says that. So that's why you guys have to come up with some kind of agreement terms or some kind of contract to one another of all the responsibilities that you're going to be doing and what's the amount of profit that you should be taking out and so on and so forth. So again, you definitely want to be very, very, it takes a lot of time to build a partnership, especially if the person that you're building the business with, are they someone that you can trust? Are they someone that you've been working with for a long, long time, right? Are they someone that you can trust? Number two, ability to raise funds. Yes, if you have more than one person getting the money, well, you have 2 or 3 people involved that can help you be able to get that money. So again, one person could be the person that's doing the in-store sales. A second person can be running the show and trying to look for people who want to buy your product as a sales representative, or someone could be looking into being a wholesaler, right? Or someone who wants to buy in bulk. There are many reasons why you guys can be able to create more money because, again, you also be able to looking for grants and some extra funds, right? So in this case, you have more than one person who can be involved to be able to help generate more money. Number 3, tax deductions for profits. Yes, every partner gets to get a nice tax deduction for the profits that they are earning. Because in this case, right, a small business, because usually partnerships are small businesses anyways, they again, you get more benefits as a smaller business than you do as a bigger business, right? So in this case, you get a tax deduction on those profits. Okay. And then number 4, hiring employees that may become a potential partner. Yes. So again, for example, if you ever have a little small mom and pop shop, right? Let's say that the mom and pop didn't have any kin, so there's no person that they can you know, there's no person that they can what do you call it, there's no person that can inherit the business, the family business. So in this case, right, what can they do? Well, if there's a person who's a loyal employee, so someone who's been working there for X amount of years and they've been moving up and up and up into the company, right? They could potentially be saying, hey, we're planning to start to retire soon and we don't have any next in kin. So are you interested in becoming a partner? And what we can do is just be a silent partner and so on and so forth. And you run the main core operations. So again, that is very likely and that is very possible. So again, hiring very high caliber working individuals because they could potentially become a business partner, right? That's a huge advantage. That means you're going to get quality workers over another business. All right. Disadvantages. Disadvantages can be, well, you are still responsible for each partner's actions and their decisions. So again, here's a little fun fact. So when you are running a business, right, both partners must agree on a decision. Okay? If for any reason that partner A and partner B are trying to, make a decision whether they should either create another department or something like that, right? If partner A has to go to a business meeting, right, with the decision in their hands, and partner B does not know anything about it, and partner B is somewhere and can't make it to the meeting, and partner A decides to say, I'm going to go straight forward and proceed with this new division. If partner B does not know that, partner B can revoke that decision because, again, both partners have to know what the decision is and both of them have to agree. So in this case, right, if one of your partners is trying to undermine you and start building a business behind your back, you can revoke their decision because, again, you are a partner into the business. If you're not knowing of what's going on, then that decision can be revoked. All right? But if, second scenario, if partner A and partner B has made a decision and has spoken with one another and they both are agreement, right? If partner A has to go to that meeting and partner B is somewhere else and partner A says, let's proceed with the new department, then that decision is final because both parties are agreement, both parties said yes to this, and both parties discussed about it prior to the meeting. So in this case, that is an example again that you can make in regards to a decision. Okay, and again, that is one of the decisions. So if making that department, right, if that decision end up failing, then both parties are responsible for making that decision because they both agreed on that decision. So that's a little fun fact there. So then now you know that if your partner, if you decided to go into business with a partner and they try to undermine you for any reason, you can immediately revoke their decision because, again, if you're not knowing of what this decision is, then it's not considered legal or binding. Okay. Number 2, profits are shared, right? Nobody likes to share profits, right? Everybody wants money for themselves. So in this case, depending on how many partners you have, again, it's 2 or more. So if you have 4 partners, right, then you're only going to get maybe 20 to 25% of the profit. So again, many people rather take more than a lot of the profits for themselves. So again, that is a disadvantage, is the money is being shared. Number 3, disagreements. Yes, disagreements can lead to a partner to leave, right? So again, if you're having disagreements, of course, it's very common between partnerships is that if someone thinks that a good idea is in place, but the other person thinks it's not a great idea, well, that's the thing. That's where relationships get ruined as well. Because if a partner has to undermine that person, right, and make the executive decision for themselves, then that's where disagreements can happen to the point where that partner can decide to leave it whenever they want. Okay? So again, disagreements will happen. Number 4, some employee benefits are non-deductible to the business. So once again, that's also a disadvantage as well. And last but not least, limited life if a partner leaves. So again, if you are a 2-partner person, right? If a partner decides to leave, you have 2 options. You either reestablish yourself as a sole proprietor, or you either look for a new partner or look for a silent partner. Okay? That's what you have to do. So in this case, again, it is a limited life just because there's no guarantees if the partner's willing to stay in business with you, because they can leave their contract whenever they like. They can sell their part of the business to either the other partner or whatever it is, right? So in this case, they have to, your decision is you either reestablish yourself as a sole proprietor or find another partner. Okay. Any questions in regards to partnership?
No.
Okay. So let's talk about corporations. Okay. Corporations. So here is a huge thing about corporations, right? They are all over the United States. These type of corporations have characteristics that build up a corporation. So again, these are the 4 key features or key characteristics that make up a actual corporation. So number 1 is shareholders are going to be limited liabilities, right? Now, when we talk about a corporation, right, it is its own separate entity. The people who make up the corporations are going to be your stockholders or your investors. So, for instance, right, I can invest my shares into Target, right? That makes me a part. I own a part of the business, right? Because I invested my money into this company. So that's what you have to understand, is that that's the huge difference between a partner and a sole proprietor, is that this business is its own entity, and the people who make up the company is going to be the people who invest in that company. Okay, now let's go ahead and talk about a fun fact here. In order to become corporate status, right, you do have to go ahead and apply the business entity, right? And it's going to be incorporated based on the state it is headquarters in. So therefore, whichever state that established this business organization is going to be the state that's going to incorporate, right? It's going to be incorporated into the state that it is established the business in, right? So that's something that you need to know, because again, when you you build your brand, right, and you become well known, that other people who want to invest in you, right, other corporations can invest into your company, or someone who has a large investment on their hands wants to invest into this company, then you're going to have to go to the state and apply to get your license incorporated, so then you can become available to the public through public trading, right? The Wall Street Journal's public trading. And that brand of that, you become a brand, right? A company that people can want to have a part of. So in this case, that is something that you need to know. So once you build your brand and you become your own entity, right? Then go to the state and you're going to incorporate yourself. And of course, you're going to build your headquarters there as well. And when that happens, then anybody who wants to be involved into your company, right? You set out your shares, and people want to become part of your business. They just invest a part of their money. Okay, so that's number one key, is that those individuals will be supplying the money for this business. Now, because they are supplying the money for this business, they do not become liable for any of their personal assets, right? So therefore, whatever money that they invest into the company, right, is the only thing that they are responsible for. Okay, all their personal assets, right? Anything that they own, right, is theirs and they get to keep it. So that's the thing about stocks, is that you're only investing your own money, nothing else. So that's why the shareholders are limited liabilities, because they are only limited to the money that they invest into the company. Now, if you're going to be investing $1 million and owning a huge chunk of the business, yes, that does hurt, because again, if the business does go down and goes out of business, then your $1 million investment is going to basically be very painful to you, because unfortunately you won't be able to get that money back, right? But that's the idea here, is that nobody owns the business, everybody owns the business. Okay? Number two, a central management or some kind of government needs to be placed. So again, an example would be a board of directors, right? Every corporation, since nobody owns it and everybody owns it, right? Who's going to be actually running the business? So the board of directors usually are elected by the shareholders themselves. So anybody that's a part of the company, right? They are going to be electing these individuals to help run the business, because again, these shareholders, they just want to just be part of the business, but their involvement in the business is also limited as well. If you want to be more involved into your business, so the more shares that you purchase, so the more ownership that you have on the business, of course you want to be involved. But for someone like me who just wants to put $10 into Target, I don't want to be involved in making any executive decisions or be involved in any decisions in Target, right? So in this case, right, the board of directors are elected by the shareholders themselves, and there's always a shareholders meeting, depending on what it is. So again, anybody who owns a part of the business will be participating in it. And the board of directors, what they do is they elect a president, a CEO. They do a the vice CFO, right? They have someone who's in charge of sales, management, and so on and so forth. There's a lot of different positions that can be elected for the board of directors. Okay? Number three, transferability of shares through dividends. Okay, so again, how do they distribute their profits? So that's number one thing, is that when people invest into a company, that they believe that their brand is so great that they have the capabilities of making lots of profits, right? The decision is that people want to get money out of their investments. So in this case, what's the way that they can transfer the profits? Through dividends. And again, those are executive decisions based on the board of directors. If the board of directors wants to take that profit and invest it in a project into the company, the shareholders the shareholders agreed with the board of directors, then the board of directors will be making those executive decisions. So again, not every company that you put your money into is going to be distributing any dividends. Okay? But that's how they transfer the profits is through dividends. Okay? And number 4, continuity or life that will live beyond the life of any shareholder. What does that mean? Well, in this case, right, since the corporation is its own entity, the lifespan of this business can still be a business as long as there's at least one shareholder. Okay? So think about it. If Target has 1,000,000 shareholders, right? And let's say all of a sudden something happened and no one wants to buy Target, they start selling their stocks like crazy, and now there's only down to one person. That one person's going to own the entire company. Great. That will still allow the individual to be able to continue the life of the corporation. But as soon as that one individual leaves, right, of course the business entity will still be floating, but there's just going to be no activity, no production, because again, if no one wants to invest into the company, right, then therefore there's no board of directors, right, because then there's only one person that's making the decision. So in this case, right, the business is still there, but it just wouldn't no longer have any activity or any production at that point, right? But it still lasts the length longer than any shareholder that exists, right? Because think about it. Target's probably like maybe 60, 70 years old, and anybody who invested in there, right, they're probably long gone after they, they probably passed at that point. So in this case, that is what this also means too, is that the corporation, because it's its own entity, whoever makes up the shareholders, it will definitely last longer than the life of any shareholder. Okay. All right, so those are 4 characteristics. So make sure it's important that you remember and understand these 4 characteristics, because it's going to apply to the next business organization. Okay. So what are the advantages and disadvantages of being a corporation? Well, number 1, well, the shareholders have limited liability. Of course, that's a bonus, because why would someone want to invest into a company if their personal assets are at risk, right? That's not fun to do business if I trust if I trust this brand so much that if I invest into this business, then my car can be repossessed by the bank because of the company's decision on moving forward on a decision, right? If it was a bad decision, then why does an individual have to pay for it? So in this case, so that is what is a great advantage, is that every shareholder, they're only limited to what they invested into the company. Right? So that's a huge advantage. Number 2, shareholders are only held accountable for their investment into the stocks. Okay, so again, that is part of number 2, right? That they're limited liability. That means they're only responsible for the money that they involve into the company. Okay, and then number 3, raise additional funds. Okay, through sales of stock. So yes, they have the capabilities to raise their money, right, by selling more stock. So if you ever heard of those instances, if you ever go on a Wall Street Wall Street itself, or go through some kind of stock app, sometimes these major corporations, they will have a short stock sale, or they will have, hey, take advantage of this time now. If you buy now, you can own up to 5 stocks for the price of 1, right? Because they're trying to entice and want people to invest into their company by having these deals out. So you can get you could get 5 stocks for the price of 1, right? Because what they're trying to do is they're trying to, again, pull you in by saying, hey, and then in the future you could trade off those stocks when they become either lower or higher in value, right? So again, that's definitely something that corporations can do, and that's the great thing, and it's an advantage because again, they have the ability to raise funds instantly through by the sale of stock. Okay, tax deductions for having employees. Yes. Okay. So again, we will talk about tax deductions as employees. So because the business itself, it's a corporation, it's its own entity, it can write those tax deductions for having employees. Okay. And of course, number 5, it can elect to be taxed as an S corporation. Now, I want to educate you this because some people think an S corporation and a C corporation are two separate entities. No, they are not. They're both corporations. The only difference between an S corporation and a C corporation is, well, a C corporation, they're put in the tax and they get filed taxed twice. One for the personal level and one for the corporation level. Okay? Where an S corporation, the difference here is they're only getting taxed once at the personal income level. Okay? So that's the huge difference that you need to know. Now, is it better to be taxed twice? It can be depending on what kind of business you are, but again, if you have the ability to be taxed only once, again, that would be better for if it's better for your company. If your company is not, it's not quite there yet, then an S corp would be perfect for you because again, C corp, again, if a business can pay for the taxes, they'll pay for the taxes. Okay, so again, so that's the ability of which is a great advantage because you can choose to get taxed only once by the IRS. Okay, so that's the huge difference is that there's no difference between the two corporations except for how they're being taxed. So that's why we establish them as C corporation or S corporation. Okay. So again, what are those disadvantages of being a corporation? Well, number 1, right? It requires a lot of time and money to establish a corporation. So again, right? What does it mean by time? Well, in this case, right? Time means building its way up to become corporate status. So again, a business will always start as either a partner or a small sole proprietor, and it takes years to build your brand name and to get to the point where people want to invest into your brand, people trust your brand, so that's where then you become in corporate status from there. So again, imagine Target, right? Target was just a small shop here and there, and then they started to become popular and they started building more and more stores. Then that's where they became established, incorporated later on. But it took them quite some time to get to that point, right? Now, if you are for example, Toys R Us, right? They went out of business. So imagine how much money you need to invest in order to reestablish Toys R Us and have it back into operations again. They closed out how many stores and now they're back into business, but they have limited amount of stores that are available. So again, think of how much money you need to invest in order to reestablish yourself as a corporation, for people to trust your brand again. Okay? It's a lot of money. Okay? Number 2, okay? The corporations are heavily monitored by the federal, state, and local agencies, okay, to follow regulations. And this is due to the Sarbanes-Oxley Act of 1992, or not, sorry, 19, one of those numbers. So in this case, what is the Sarbanes-Oxley Act? Well, that was when Enron was a very, very popular corporation, right? And what they did is, because the government and anything, right, was not super involved in their business, right? They took advantage of the government, made their books really clean, and because again they frauded the IRS, okay, um, and so on and so forth, to the point where once someone found out through the whistleblower, then everything went downhill, and then from there, that's where they created the Sarbanes-Oxley Act. So that is exactly why now any corporation is going to be really monitored down by the federal, state, and local agencies to ensure that the corporations don't ever do that again, and don't ever fraud the IRS or fraud anybody that are in the process. Okay, so again, um, yeah, so again, because again, a lot of people say this, that corporations are evil, right? Because they don't care about anything except for making money, which is true, right? But what they mean by evil is that they're also in a way of trying to make their books look clean enough for them to pay lesser taxes and writing off every little expense as possible. So again, that is exactly why federal, state, and local agencies are now involved with these um, business organizations because of the Sarbanes-Oxley Act. Okay, so again, that is a disadvantage, because then you can't be able to run the business the way that you want it to run, right? Not that it's you should do it legally, but there's some loopholes to the system as well. So, but in this case, you want to know that if you are going to be participating in a corporation, there are some rules and regulations that are governed, and of course, being monitored by the federal, state, and local agencies. Okay. And of course, number 3 is, if you choose to not do S corporation, then you will have to end up paying higher taxes, right? So you get tax at the income level, and you get a second tax for the corporation. Okay. Any questions here about corporations?
No.
Okay. Next one's going to be limited liability company. Okay. What is a limited liability company? Well, it is a hybrid between a corporation and a partnership. It has characteristics of a corporation, but it runs like a partnership. So that's why it's a hybrid between the two. It's not a corporation that runs like a partnership. Okay. So make sure you understand that, right? It's a corporation, but it runs like a partnership. It has characteristics. So in this case, in order to identify yourself as a limited liability company, is that the corporation, right? The aspects of a corporation, it must have at least 2 characteristics of a corporation. Okay, so once again, it's not a corporation, but it's a legal entity that acts like a partnership. So what are those 4 characteristics again? So if it has to have at least 2 of them, right? Number 1 could be either they have a central management, they have a board of directors, right? And then they can have shareholders, okay? So in this case, that is what I mean by it has to have two characteristics of a corporation to exist as a LLC, okay? But as the end of the day, it functions as a legal separate entity, but it more likely does everything like a partnership, okay? So the advantages of that are, number 1, right? A taxation, right? Because it's part corporation, part partnership, right? They can be taxed as an S corporation, meaning they only can get taxed once. So again, tax to the government is flexible, which is a huge advantage. Okay. Number 2, limited liability, because again, if the key characteristics of shareholders who are involved in the company, if they're limited liability, So are the people that are involved in limited liability companies, right? They are only they're only responsible for the money that they invest into the company, nothing else. Their personal assets are not involved, right? Number 3, can elect membership members to be the entity. So again, very similar to board of directors, right? They can elect one person to be the actual entity itself. Okay, so again, very similar to also to a general partnership, right? You need to have one person who can manage the entire company. Okay, so in this case, that means the rest of the members, right, they don't have any extra liabilities or anything like that. So that's a huge advantage that one person can control the entire company. Okay. Number 4, no annual shareholders meetings are required. So again, if you are having shareholders as one of your characteristics, again, you don't necessarily need to have shareholders meeting because again, you're partnership, right? You're the whoever's involved into the company is going to make those executive decisions for you because you have someone that you've elected as the main person of the company. So that's a huge thing, is that you don't need to involve anybody else that's in your company. Okay. And again, number 5, less administrative work and record keeping. So again, this one's kind of vague, but this one is basically saying that you would have less paperwork to do in regards to keeping track of your financials and things like that. But again, this is very vague. But it's less administrative work, meaning, for example, like if you're going to be running shareholders meeting all the time, that is going to be more admin work. Okay, but because you eliminate that, you have less admin work for that in that cases. Okay, and then number 6, membership's interest can be assigned. So again, membership interests. So again, anybody that's interested in the company, right, they can be assigned to a specific portion of the company itself. Right? All right, and then disadvantages. Okay, disadvantages of limited liability companies is at least 2 owners must be a part or member of the company, right? Because again, it's part corporation, part partnership, right? You can't run the show with only one person. It has to be 2 or more individuals, or they could be members of the company itself, right? Number 2, can have limited lifespans because of the partnership, right? If one person decides to leave the company, right, even though they're limited liability, right? If one person decides to leave, then your option is you're going to have to demote yourself really, really far back down to sole proprietor, or look for a silent partner and run the show back up again as an LLC. So again, it can have a limited life if a partner decides to leave. And then number 3, may have self-employment tax. So again, that's a disadvantage because again, as a partnership / corporation, depending on who your partners are they again, if because the entity acts as a partnership, most likely that it's considered a self-employment type of business, right? A small business that's a self-employed, so you could be taxed that way. Okay. Number 4, if profits exceed 50%, it will be taxed by the federal government. So again, IRS, right? They set parameters. So if you make way too much money as a partnership, they will tax that money if you obtain those profits. Okay. Number 5, cannot take advantage of stock options. So what does that mean? Now, if you guys have worked for a company before that allowed you to have a retirement benefit plan where you get to become part of the company by owning a share of the company, this is what it means. Stock options, meaning it's a retirement benefit plan where when you retire, you still have the stock as part of the business, right? In this case, it's a disadvantage because if you are going to be part of the company, you cannot own the company. You cannot own part of the company. All right, so there's no way that you'd be able to take advantage of stock options. Number 6, some states tax LLCs. So you're gonna have to look at the state that you are currently doing business in. Is it something that LLCs can be taxed for? And then, of course, number 7 is that when you convert yourself from any existing business and convert into an LLC, you may be taxed for the assets. For in this case, you might be taxed for applying for the business for that license. Okay. Any questions in regards to limited liability companies?
No.
Okay. Yes.
So, converting an existing business into an LLC, um, can you explain that last part again?
So, for instance, you know how like you're a partnership, right? If you're trying to move from a partnership to LLC status, depending on what kind of like what your business holds or what your business entails, right? If for any reason, depending on the state that you are in planning to incorporate your status in, excuse me, not incorporate your status, apply for the LLC status, you may be taxed for that. For applying to switch from partnership to LLC, because it does take time and it takes a lot of money too, but they're also evaluating your current positioning. Are you able to be becoming an LLC, right? Because you have to also, again, in order to become an LLC, you need to be well established for other people to invest into your company, right? Because you have to have two characteristics of a corporation. You either have to have stockholders, you either have a central government, or you distribute your profits through dividends. You have to have two of those characteristics of a corporation. So in this case, when you're switching from a partner to an LLC, they're going to value your assets, and for any reason that it is because you're trying to establish yourself as an LLC, you can be taxed for that.
Okay, cool.
Yeah. So again, any kind of business, right? It does take time to develop and become when you get to that status, especially when you get to corporate status. That means people trust your brand to the point where they want to invest in you. So again, you can be taxed for trying to switch from a partnership to an LLC. So again, it doesn't happen overnight. All right, last business organization here is going to be non-profit organizations, or they have non-for-profit organizations. Okay, however you know it as. Okay, these individual entities are truly have no means to generate money for the business itself. So again, hence the word non-profit, right? They're not here to make money. They are here for one reason and one reason only, to educate. All right? So these organizations, they have a means to spread awareness, whether it is based on some kind of culture, some kind of religious belief, something that's educational. Maybe it could be something that, for research, for instance, right? Cancer research is the very popular one for professional reasons. Okay, so again, they have a sole purpose to provide some kind of educational service that can either educate individuals about these specific specific topics, right? So these types of organizations do not have any owners. You know why? Because these are purely voluntary, as in people who believe in the cause will volunteer their own time to be involved into supporting the cause. Okay? So in this case, there's no true owner, right? And it's only people who volunteer that want to be involved in spreading the awareness of these topics, right? Now, most cases, how do these organizations actually get money? Well, most cases, it's being funded by their own members themselves through membership dues. But the thing about nonprofit organizations is they are able to have fundraisers, right? They are able to get some generous contributions, okay? And even the federal or state organizations can also put some grants in there. So again, for instances, a lot of corporations that want to make themselves look good in the public eye is that they will choose a nonprofit organization and they stand by it and they donate lots of money to that cause. So for instance, McDonald's, right? They have the Ronald McDonald um, charity for kids, right? For instance, Macy's, they support the Make a Wish Foundation, right? So again, these corporations, again, that's why when people say they're evil corporations, this is how they make themselves look good, so they're not so evil at all. Oh, well, every dollar that you spend here is going to go to some organization. We're doing something that will kind of, what is it, bring and contribute to the community, right? The Boys and Girls Club. And then here's some examples here. We got PETA, not the school PETA, but PETA, the protection of animals, right? You got Susan G. Komen, which is breast cancer awareness. You have St. Jude's Hospital, which is cancer research in children. You have Comic Relief, which is, I believe it's AIDS. Okay? There's a lot of nonprofit organizations that do exist right now, and their sole purpose is to raise awareness, but also raise the money to either, for example, St. Jude's. They're taking that money to do cancer research for the children. Where Make a Wish Foundation, they raise that money to provide a dying wish for the children. Okay, so again, these organizations, they run themselves based on pure voluntary, and again, how they're funded is based on contributions from other individuals. Again, they can even have a website that says, please donate to us now, and then donate now button on their website. So they're not purely generating money, right? They can sell items, right? That's going to go towards their cause, they say. But again, nonprofit organizations, um, they they again are not there to make money. They are there to spread awareness. So again, hence they're non-for-profit. And these kind of organizations, because they're non-profit, right? They get special taxes, right? Because they are not generating money for anything other but to go towards paying their members, right? Paying their members, the whoever are the ones that the CEO, right? But also paying the money into those other companies that are doing the research for them. So again, they get separate special taxes because again, donations is a huge one, right? You're getting donated free money. Free money's free money, but you can get heavily taxed on that. So it's just like when you win the lottery, right? You get heavily taxed on that because it's a special tax because it's free money, right? So any questions in regards to nonprofit organizations? All right. Yes.
is St. Jude a cancer research hospital?
Yes, I believe St. Jude is a children's hospital, and they do cancer research for cancers in children. And what they do is they help the parents pay for all the medical medical bills because their children is in the hospital for cancer or whatever. I believe it's not just only strictly cancer. I believe it's pretty much any type of cancer plus any type of disability, I believe. So again, they help families be able to afford those medical bills while taking care and treating them, and also doing cancer research on those individuals that are in those hospitals. Yes.
Um, how does it make sense to have no owner for the nonprofit organization?
So in this case, no owners because again, no one wants. In this case, right? There's no owner because it isn't technically something that is very tangible, if that makes any sense. This is a belief system, right? And you're having a group who share the same belief. So in this case, you don't want someone to own that. You'd rather have nobody own it and have everybody be contributing parts of it. Does that make sense?
Well, how would somebody found one or started a nonprofit organization if they're not the owner?
Well, okay. In this case, if let's say you want to create a business, or not a business, but if you want to create a nonprofit organization, well, would you feel right to say that you're the owner of this business? That I own these people who believe in the same cause? So in this case, the reason why there's no ownership is because of the connotation, oh, they don't want someone to control people. But in this case, you can also see it as that no one really owns the cause. No one owns this religious belief.
Oh, okay, I see.
Yeah, that would probably be the most best answer for that because in this case, right, you're like no one can really own these ideas, right? It's only a shared opinion amongst a group of individuals. And their main goal is to get more people involved into this idea of theirs. Any other questions?